Welcome, everyone, to Investing for Generational Wealth. Let us dive into the world of expert financial insights and strategies. This is your host, Keshav Kalor, and I'm joined by my partner, John Laya here. Welcome to today's episode, How to Evaluate Your Passive Investment with Justin Smith. Before we begin, here's a quick disclaimer. We are not financial advisors. All investments are subject to risks, including the possible loss of the money you invest. So perform your due diligence before making any financial investments, and of course, consult your CPA and your attorney before beginning investments. Today's guest is Justin Smith, and Justin is the founder of Relequity Enterprises, a housing and real estate development firm. He has spent pursuing his childhood goal of owning a city block and one of his personal passions to build student housing and living communities. Professionally, he has led projects through the entire development cycle, from capital analysis to the pre-development stages, design management, construction, and asset management. Justin has led the successful development and construction of on-campus and off-campus student housing projects, including 1,356 units of housing constructed over the last 7 years, exceeding $600 million in value. And he has had public and private partnerships with institutions such as UC Berkeley, Boise State University, and Sacramento State University. Thank you for being here with us today, Justin. And with that, let's get into it.
Justin, well, thank you. Thank you for having me.
Yeah, if you could start off by introducing yourself in addition to what?
Yeah, no doubt. Thanks for that gracious introduction. My name is Justin Smith. I founded a firm called Relequity. Relequity investments and advisory practices, and we do a host of different things. But essentially, we like to realize our dreams. We like to realize your dreams, and we like to help the community continue to thrive, foster, and grow.
Great. Okay, thank you. If you could give us your backstory, how did you get into this? What does your journey look like? Just a quick synopsis.
Yeah, really the backstory and the front story is the story. I started off sort of with the passion for the built environment, with the passion for art, architecture, and building things, right? Starting off with, as a young one, kind of thinking about, hey, well, what do I want to do when I grow up? Or what do I like to do? And my mother always said, live your life through your passions. So at a young age, that's what I wanted to do. My inspiration came from a neighborhood project that was a vacant lot, and a young entrepreneur and African-American developer right in Oakland, California, put up a whole host of Victorian homes. And that's what really opened my eyes to the opportunities of taking barren land and building a project out of it, and replicating something that was already in the neighborhood, and then replicating, houses and Victorian homes that looked just like the older ones that were 60 and 70 years old. So that was a real inspiration for me. And for that, that really got me hooked on, oh, okay, well, if you think it, if you design it, you can build it. And so, it took me through courses, architecture and construction management, and then eventually going into, investment finance and real estate finance, and kind of putting the whole picture and along the way, doing a bit of it myself with single family residences, with duplexes, with small multifamily, then graduating to some of the larger stuff. So it's just been a lifelong passion of mine.
That's great to hear. And where are you based out of?
I'm based out of the San Francisco, Oakland Bay area.
Okay, got it.
Yeah.
Cool. And what would you say your primary focuses are in commercial real estate? You'd say student housing and multifamily?
I would, yes. And I'd add a third piece, which is workforce housing. And that's from an opportunistic lens that essentially the Northern California Bay Area and many other areas has a strong need for housing. just the three major cities, let's say San Francisco, Oakland, San Jose, they're almost 200,000 units short of where they should be, right? And we just can't build fast enough. We can't, develop and entitle projects fast enough to really meet that curve in the next foreseeable future. So that's definitely a strong area that I have experience in and want to see things continue to happen. And the tide is sort of moving in that direction with many types of projects, whether it's projects aligned with cities, counties, faith-based organizations, with nonprofit organizations, and so on.
Gotcha. Okay. And this is probably too vague of a question. I guess at a high level, what are some of the main pillars that you look for when you're evaluating a passive investment opportunity, right? You said that there's a lot of this housing that needs to be built, and that's going to require a lot of capital, and that's a great opportunity for a lot of investors to both drive financial returns for themselves, but also contribute positively.
Yeah. I think that when you're starting to look at sort of passive investment opportunities, and you're not the general, it's not an active investment for you. You're not on the general team or the GP team, as they call it, right? And you're maybe an LP and want to do it passively. I think you really have to evaluate the team, right? Because you're aligning yourself, your current interest, your future interest with theirs. So you really need to know that there's some synergy there, that there's a team there, that there's some experience there, there's some foresight, there's some general understanding of how you do things and how they would do things. What is your mission alignment? I think that's really important, and understanding sort of who they are, right? It doesn't make sense to jump right into a deal with the team and not really understand those intangible variables, right? Because ultimately, in some respects, they might call it a marriage, right? Because you're with that group for, it's usually a 5-year hold. It may be 3, but nevertheless, it's usually a 5-year hold. So it's a long time, and so you're really building a relationship with that group. So look at that. And the second thing I would say is really understand what your buying criteria is. Is this an asset type that you're familiar with? Is this an asset type that you see yourself involved with? Do you see that happening in your community? Do you see that happening in the community where you're investing? What type of asset type is it? And really try to understand and learn that. And I'll give out a few asset types. There may be asset types like self-storage. There may be asset types like senior housing, workforce housing, student housing. It could be industrial. It could be cold storage. And it goes on and on from the real estate spectrum, and there are others and other passive investing spectrum. But I'd say those two things: understand who the operators and who that team is, and then have some general understanding for that type of product type. Make sense?
Yeah, that makes sense. Gotcha.
Yeah.
What are some good questions to ask with respect to, again, the team, but also the deal, right? I know one thing that I always recommend to people is to read The Hands-Off Investor by Brian Burke, and to kind of go through that as a framework. What are some top 3 questions they always ask a new sponsor, or that you would recommend people ask a new sponsor?
Top 3 questions to ask a new sponsor is, if the building drops from 100% occupancy or 90% as presented and goes all the way down to 50%, where half the building is empty, what would you do? Right? If you're not able to rent the building out because it's based on rents, what would you do? And really, maybe that's the same question, right? The second question is, how are you improving the community with this particular asset? What are you doing with this? Because usually with multifamily deals, and I'm assuming this is sort of on the larger end, your 70 unit, your 80 unit, and so on, 100 units and so on. So really, you have many these are communities. This is where people live, love, breathe, and raise families and so on. So I'd say that that'd be that second question. And then the third question would be, what happens when something goes wrong? Who do I call? You know, what happens when, something goes wrong on the property and I hear about something? Who do I call? Who's my go-to person? So those are not your standard questions, but those are questions that team should understand. Those are questions that team should have their understanding around how they're going to deal with contingencies, good, bad, and indifferent. So those would be the type of questions that I would ask.
Can I ask a follow-on question
Sure.
with that?
Yeah.
So turn it around. What if an investor asks you those questions? So if an investment opportunity drops to 50% occupancy, what do you typically do? I guess, how do you assess that? And then the other questions, who do you go to? Who's your go-to person? And then how do you improve their community? I think those are great questions, right?
Yeah, no, just writing down a couple of notes. But the first question in terms of my deals usually involve not just the asset, but a mission-driven and thematic approach. And what I mean by that is any deal that I get into needs to fit into the mission-driven criteria that we sort of engender, and that's 3 C's: community, collaboration, and cash flow. You need to have alignment of those 3 ideologies, which eventually go into 3 practices, which can eventually move into benchmarks. So let me break that down a little bit. Community. So you got to understand that it's not just an asset. It's not just a piece of real estate. It's someone's home. It's a collection of homes. It's a collection of community. It's a collection of a youth that may live in that particular area. So how are you making that property a community? Because now, how does that affect you with the 50%? Because happy people equate to happy residents, equate to high occupancy, equate to greater than 90% if you're doing all those things right, right? And so you're really building community around that. You want to have, and so let's get a little bit more granular. What are you doing on special holidays? Do you have a little 4th of July something for your residents? Do you have a little Cinco de Mayo party? Is there a little, Oktoberfest, or is there a little Halloween something going on? So really build community so that you don't get to that 50%. If you do get down to that 50%, then you may have to thematically build in a program that attracts people there. What's the curb appeal? Yeah, curb appeal is one thing, but living there as a community and being there, feeling safe, feeling proud of your neighborhood, a pride of ownership, or a pride of home ownership. And I know this may be a rental situation, but proud of your space. That helps you either get from 50 to 90 or stay at 90 and stay there with that. The next thing is go to, right? You do need to have a team of key people that are responsible, boots on the ground. And it might be one person, it may be several, but you need to be responsive. And responsive to your investors with great communication and leading communication, but then also responsive to that community. So if they have questions, right, they can say, okay, well, we're going to call X, Y, and Z property management firm, or and if they can't call them, we'll go to the asset manager and that type of thing. So and then lastly, if you can build the community, build that relationship, be that go-to, and be responsive, the cash flow should follow. You look at then you start putting benchmarks in place. Well, where's our cash? Where's our occupancy level now? Where's our loss to lease now? how many renters are at this particular level and how many are coming up for renewals. Then you start looking at all those benchmarks and pieces to ensure that you can maintain the cash flow levels that you might have introduced to your investors coming in. So that's how the three C's in my mind sort of work together and how they're integral in terms of creating a healthy environment and a cash flowing opportunity.
That's great. Thank you for that.
Mm-hmm.
That makes sense. And I guess on the other side of that question, right, instead of what are three things, what are like three, maybe instead of green flags, like red flags that you look for when you evaluate a new sponsor team, or let's say we'll start with sponsor team, red flags.
Mm-hmm. You know, some of the red flags are experience, you know, and how much of this do they do? How much does the team do? Or is it just like, hey, you know, we're just out doing these projects and we're all for the money, or we're all for the mailbox money, or we're all for these different, you know, sort of anecdotal kind of references that are out there. Because that's almost like a TV commercial. It's a lure to get people in, right? And that's great. And I understand how that works. But also, you know, how vested are you, right? So looking for those red flags would be, you know, just having a lot of the eye candy in terms of, hey, this is attractive, this, that, and the other, but maybe not having the systems or having the understanding that this is a longevity, that this is a long-term deal. So to me, if you don't have the alignment of sort of a long-term perspective as well as the eye candy, then that's a red flag. The experience can be a red flag. Not understanding the demographics or the asset or where the asset is, you know, in real estate, they obviously, you heard the term location. So, okay, GP team, how well do you understand location? Is that just three words, or is that three real places that you have to understand as it relates to activating that particular asset? Because in each new deal, you're really reactivating that asset, right? At its highest level. So what's your reactivation plan? And if you don't have that plan, and it's just like, hey, we're going to get in and we're going to, you know, have fun and we're going to, you know, make mailbox money, then this and that, that's a red flag. Make sense?
Yeah, that makes sense.
Yeah.
And yeah. How about with the deal itself?
With the deal itself, I think you got to look at a number of things. I think you got to look at, you know, a couple of anecdotal things. What type of property is it? Is it Class A? Is it Class B or Class C? So you really have to understand that. Once you understand that, then the deal itself, you start to evaluate each one of those. If it's Class A, you know, what are the rents in the market? You know, how new is it? You know, what's the possibilities of other properties being built or under, you know, how many cranes are in the air, right? You know, in that particular area. If it's a Class A deal and you got 12 cranes in the area and it's growing like crazy, well, that might spell some difficult circumstances or challenging circumstances as it relates to occupancy. And that aligns with revenue, right? Because you got all this new product, and you know, a year later, everybody leaves yours that's a year old, and they go to the one that's 1 month old, and then that becomes a year old, and then everybody leaves and go to. And I know that might be a little bit comical, but you do have to understand that. And then with your Class B properties, you got to have to look at, you know, that's more in your value add. You know, it's a little bit older, but what's going on there, and understanding that particular type of product and what that actually means. And then your C and your D are probably a little bit older, so you're looking at CapEx. You're looking at the type of building. You're looking at, heck, you might be looking at, you know, pest problems and things like that. You're looking at, you know, sewer systems, storm systems, water systems, your roof, you know, HVAC systems, and it may have a little bit more of that in the property, that more CapEx and OpEx and things like that you have to deal with. So looking at the deal, it's important to understand if it's Class A, B, or C. And each one of those can have its own sort of checklist of things to start down that road. They're all assets, they're all real estate, but they're slightly different in terms of its approach from an investment perspective, from a buying perspective, and then from an asset management perspective.
And even as an LP, you think it's important for investors to look at that down to detail, like things like pest control or, how old are the pipes, things like that?
No, I don't think that an LP should be, as concerned with that. But, well, let me say it like this. Let's say you're an LP and your GP team is going to buy a particular property in a particular city. And you go on, some website that evaluates properties and has renters and gives reviews. And you see that there's a bunch of reviews, that there's a bunch of pest problems, over the last 2-3 years, it's like it's getting 1 stars and 2 stars and things like that. That information is there. That history is on the internet, right? So maybe you as an LP go, hey, I see this property has gotten consistently 1 or 2 stars. I've read the reviews. People think the place is a dump, and we're going to buy it. And what's your plan for turning it around? So you may not be looking at those things specifically, and you might think those things are beneath, sort of the conspicuance of an LP, but they're not, because they were just right. Those things are kind of right out there. So I think that LP should do their own homework, should do that cursory review, go out on the internet and look at, the different sites that either evaluate or have the rent program or the apartments.com or whatever the case might be. But look at what it says about that particular asset. And then ask your team, how are we going to address this? Because this is my investment that I'm putting dollars into. So if you can't address this historical issue that's been happening, let me see, 8 months ago, 1 year ago, 2 years ago, right? And then, are you going to do the things that you say you're going to do, right? So those are anecdotal things, and they may not be looking at, how many HVAC units are failing over 100 unit deal. Not that, but some of that historical context that because it used to be curb. You guys have heard it used to be curb appeal. That was everything, right? Now it's like likes and hearts and thumbs up and stars that evaluates everything nowadays, because that's where everybody goes first, right?
Yeah.
Just a different perspective, but it is telling in a sense.
Got it. And when you're, as a passive investor, when you're valuing opportunity, what kind of information would you recommend that like the investor has in front of them? Some sponsors just give out a pitch deck, others pitch deck and underwriting, other people just even throw in market study there.
I think that a thorough pitch deck can be referenceable and good enough for that first look, right? If you see something there, if you're familiar with there, if you see a trend there, if you really understand kind of what you're looking at, a pitch deck can be a good document. And then beyond that, if you want to get a little bit further, go to that GP team or go to that sponsor team and start asking those things. Hey, did you guys get this information from a census study? Is this a market study that you have commissioned? Did you buy it off of one of those real estate sites? Can I see it? Right. And so I think pitch deck is first. And then I think if you have questions, if you want to dig deeper, I think it should be part of the responsibility of the sponsor to provide you that detail. So, and you should be knowledgeable of what you're getting into. And I think that makes sense. So pitch deck first, and then ask for greater details as you have questions or as you unfold or wander further into that opportunity.
I had a question. Just listening to your focus areas, your kind of your buy box. Part of it is an emphasis on mission. And so I wonder if you work closely with cities and counties that provide, for example, low-income housing. And if so, can you talk about the nuances, issues you encounter with, and maybe some benefits in working with cities and counties? And then what type of this information do you think passive investor would be interested in hearing about?
Yeah, with respect to, most of our projects are not they're not affordable housing projects. On the development side, there's a relationship with cities and counties that I need to have because it's a different type of they're the authority having jurisdiction, so you need to have that alignment. You need to have the relationship. But on the multifamily acquisition side, where you're buying 200 or 150 units or whatever, it's less of that. But you do need to know sort of and not in a traditional, you do need to know some of the politics and the social governance of that area, right? And that's where I think cities and counties come into play. Like, what's that county all about? Or what's that city all about? What do they like to do? Do people like to live there? What are their politics? Are they, leaning this way or leaning that way? What's the town center like that? Town center. Is there a downtown? As they say, is there a there, right? So that's where I think the LP can really anecdotally kind of do their research on a particular city. You can pull up, you can pull up Atlanta, Georgia, and kind of see what's the flavor of that city. You can pull up a Washington, D.C. or Tulsa, Oklahoma, or Columbus, Ohio, and kind of see what's the flavor of that place. And to some extent, the city and county, both politics and both authorities will kind of lean and craft in that direction. So with respect to buy box, I look to the city, what type of city, and then metrics can provide that, like crime rate, population growth, income growth, price of a single family home, rising price of homes over the last 5 years. So you can kind of look at demographics and numbers to kind of tell you some of those things without going to the city and county or having that relationship with them. Because, as they say, we're living in a very data-driven society right now. Soon to be an AI-driven society, maybe, hopefully, hope not, But anyway, I hope that answers your question.
It does, yes. Thanks. I also had a question about, as we all know, the rising interest rates, or I guess the interest rates that are kind of fixed now. How has that affected how you've invested? And then obviously as a passive investor, you're looking at that as well. It's putting downward pressure on a lot of multifamily syndications. So if you could talk a little bit about that, I'd be interested to get your perspective.
Yeah, interest rates it's an interesting thing because it's something that you can't control. But you have to allow for it. So on the new development side of things, it has really canceled, tabled, or changed the trajectory of deals altogether. On the acquisition side of things, it's done roughly the same, but it's made you think differently about it. When I first got into this industry, I read a book that was called Nothing Down. And it's not that it was a strategy to say, hey, you buy every property that's nothing down. Really what it was think alternatively about circumstances. Because if there's one thing that will happen in the real estate, development, and construction industry that you can bank on 100% that will happen, it's change. So that being the case, you got to put interest rates, you got to put insurance rates, you got to put certain metrics in that box of change and really understand how you manage, manipulate, and or control your asset around those things. So with respect to interest rates going up, what did it affect? It affected It affected you're buying, you're going in bridge, your bridge loan, right?
Mhm.
So what do? Do you buy it with an existing bridge loan product? Do you use maybe HUD product? Do you look for a different asset type? Do you try to do some type of carryback with the seller? And so it really starts to make you to think creatively. I mean, I think through some of your listeners might think, be around, doing investing in 2018, 19, and 20, where interest rates were, in the low threes and fours, and you could get bridge, and everyone was jumping into real estate and then jumping back out, and the 5-year holds were going out in like 18 months or 2 years or whatever, and making a nice profit. But a lot of that was on the backs of interest rates. Now the interest rates have gone up, and I'll also say during those years, it made a lot of, novice investors look like heroes. Now it makes, the novice investor work a little bit harder, and to some extent they should. And you got to think differently about that particular deal. So that, without going into too much deal about interest rate, because it can be sort of this rabbit hole, I'd say you got to really think differently and understand that change will happen, and interest rate is one of those changes. And how can you still effectuate that deal, knowing that interest rates are high? And then you also might have to make the decision, John, do I do that deal? Does that deal make sense? I might need to say no. Don't put yourself or your investors in a place where you have a 6-month hardship, right? You may have to just cancel that. Say no, nope, didn't. Be disciplined. So that's my thoughts around interest rates.
That's great. Yeah, thank you for that.
Hmm?
Anecdotally, like what have some of your best passive investments look like? And anecdotally, what have some of your worst passive investments look like in real estate?
In real estate, most of my investments are active. I strive for the active. I have had one or two sort of LP or GP, but some of the best has been projects where you have a well-oiled machine, a good GP team, a very active team, one that is open for ideas and communicates well with the LP. The GP LP team, communicates well together. It's a little bit smaller. It may not be as large. The larger groups tend to, you tend to get caught up in either group think or they'll take, or group reliance, meaning that one or two person will take care of it. The remaining 20 of us will sit out on the sidelines, right? So so the good projects have been projects that are led well, good processes and procedures, smaller teams, and people with good experience, And then the teams obviously that didn't do so well, interesting. Some of them were smaller, but also it goes back to that person or that person's group that's leading it. How are they leading it? What are they doing to manage that particular asset? And once you kind of uncover that stone and you see things or problems that doesn't make sense, then you quickly have to jump in and say, hey, okay, what's going on here? Let me make some adjustments and changes. And so that's been on the bad deal side of things, where we've had to kind of take a look at the team that's running the show, or the team that's the group or person that's in charge, and say, hey, look, let's just agree to disagree, but we need to move in a different direction and have those hard conversations, about what's going on.
Can I ask if your team is either currently doing more builds or buys, and in this environment, are you, well, let's start there. Are you doing more builds or buys, and are you really just, do you think this is the environment to buy, or are you waiting out the next couple of months?
I think this is a great time to buy. I don't think that you should be persuaded by all the different factors with respect to buying. But back to my point, I think it's a great time to buy. I also And I can say that with some level of confidence because I also subscribe to the concept that you make money when you buy. So now's the time. Interest rates are here. Owners are not, are not the kings and queens of their castle as they were back in 2017, 18, 19, 20. They're not asking for these astronomical numbers. They're coming down to the ground. You know, other factors. You got materials prices all over the place, and now's the time to underwrite. Now's the time to evaluate the deals and find the deal that work for you, and find it at a price point that works for you. Because while everybody's running around with their hair on fire, I'm sure you got a little water for somebody with a little bit of fire and a little bit of hair. You can put it out and you can make their life happy, and you can make money when you buy the deal, right? Because usually in times of distress or times of sort of chaos, it is also times of opportunity as well.
Do you find that in California? Just because I came from California and I know the prices of California. So do you find that that you're looking within California, or are you looking outside of California?
California is an anomaly. I'd say, like the West Coast and East Coast are really anomalies from a pricing perspective because, pricing can be so high, right? It's already built on, already at an exponential or very high sort of cost basis. A fourplex in the Bay Area, let's just say Berkeley, might cost you $3 million now, right? Does that quite cash flow? But here's the important thing to understand about California, though, because you can buy real estate in California. You should buy real estate in California. So you really need to understand if you're buying for a long play or a short play, right? Are you buying for, in other words, you buying for cash flow or appreciation? Like California, you got to understand it's an appreciation market, right? It might be expensive to get in, but it may appreciate, better than other markets. It may have limited cash flow, but you're going to make 10% on appreciation, a year from now, or not 10%, but some particular percent greater in the next year, because, we have the sunshine, we have, one of the highest economies, we're on par. What are we, the fourth or fifth largest economy as a country in the world, right? You got the beaches, you got the industry, you got the technology, you got parks, zoos, people. Albeit some of us, some of the people, we're a little bit crazy, but nevertheless, we're all fun, loving, and everything else. So for those of you listeners that are saying, "Hey, well, he's saying California's crazy," hey, I'm part of that too. So we're all a little bit kind of skeptical of something, but nevertheless, we're good people. Versus so that's your appreciation versus your cash flow markets where you can buy. The prices are cheaper. The revenues are what they are, but you can get some cash flow appreciation. Cash flow from that. Maybe a little appreciation. California might be a 6 to 7 year, year over year appreciation. That market might be 2 to 3% of appreciation year over year, but it has the cash flows. Your Midwest states, your Des Moines, Iowa's, your Columbus, Ohio's, parts of Texas and states in Texas, your Oklahomas, your Kentucky's and other places where they may be, and this is not across the board, but they may be more cash flow markets and things like that. So in real estate, you make money when you buy. Number two, you have to understand if it's a cash flow or an appreciation market.
Okay, great, thanks.
Would you recommend going, like, what kind of investor would you recommend go into an appreciation market versus a cash flow market?
You said what type of investor would I go to, or investment?
What type of investor would you recommend go to an appreciation market versus a cash flow market?
Yeah, if you're looking for a long-term play or a long-term sort of a buy and hold strategy, meaning you buy now, you manage it carefully and cautiously, and and you're looking for a 5-year, 6-year, 7-year hold, that's probably your appreciation market because, it's a longer term hold. If you're in the business and you have a shorter window, you may be looking for more cash flows up front. You may be looking for a quicker turn. That's probably your cash flow markets. You can buy at certain amounts and variables and so on, but it kicks off cash flow, and that's the thing you're looking at if you're trying to get a 6 or an 8% cash on cash return and things like that, right? So that investor should look for those cash flow markets.
Would you say earlier on in your investing journey you should be more focused on cash flow, and maybe when you're trying to build, a solid base of wealth? And since these deals, like you said, are on a shorter time horizon, you can keep money moving a lot quicker and growing at a quicker rate. Versus once you have like a more solid base of wealth to work off of, then you switch to more appreciation plays.
No, I think that if you're talking early on, I think you should have a balanced mix of both. I mean, you should have somewhat of a diversified portfolio. But early on, if you're younger in age and so on, you have the benefit of time too. So that actually works in your favor, right? So I think that's a good thing. The other thing is you mentioned or you alluded to size. I think that with respect to size, if you're a smaller investor where you're in sort of, 3 to 5 unit or maybe even 6 to 10 unit, right? You do have the time is to your advantage in some respect, right? You can hold it for long term. You can fix things up at smaller margins of cost. You might even be able to sell it quicker or faster in that arena because dollars may move a little bit freer in some of those spaces. That make sense?
Yeah, that makes sense.
Okay. Yeah. So that's what I would recommend there. But it all, then again, it all depends. But, create a strategy, be disciplined, trust your numbers, follow an approach, and then be ready for change.
What do you source your deals? And I guess we talked a little bit about looking in California versus elsewhere, but are you working with brokers within the region that you're looking at, whether it's California or elsewhere? Or are you sourcing it other ways?
Sourcing of deals is really it comes from different sources. There are some brokers there that might call and have deals. There may be colleagues or friends or people in the business that call on deals. So it comes from different sources. It comes from different places. People may try to do a deal and they can't quite get it over the hump, and they may call and say, "Hey, well, here's why I'm trying to do this and that. Do you know of a team that can help out?" And then, I might say, "Hey, well, I know John. John's, can he's got this interest in this and that. That's not particularly my geographic area, but hey, call John." So once you kind of get in this pipeline or get in this community of investors, and you stay in it and you stay disciplined with what you want to do, and you let people know what you're doing, right? And some of that is through podcasts and conversations like this. You get calls, and you share those and so on. So that's how deals kind of. So I get a pretty healthy deal flow of things coming in.
Good.
But always looking for new opportunities, because there's always that buy box there's always that opportunity for the deal to hit the buy box that goes in and it comes out as a no, right? No for me, but maybe good for somebody else. So where's the next one? So if you're listening right there and you got that great student deal and you're like, I wonder what he'll think about this one. Well, go ahead and send me an email. We'll talk about it.
Well, what is your team like? Do you have person responsible for sourcing deals and continuing talking to brokers, and maybe on acquisitions as well as dispositions. I forget, do you buy and you see you buy and hold, so you're not really as active in the disposition front?
Not well. It's interesting you mentioned that. I do have some things that we're looking on. We're active in the disposition front right now, but to get to your question in terms of team, teams are sort of geographically based in some sense. What makes me able to be nimble and go to different places and is having trusted teams in different places. Having someone. There may be several of us on my team that does the initial deal identification, talking to brokers, talking to new operators, sourcing deals, underwriting, and that type of thing. But then once it becomes something that's real, that we might tap into our team that's there and say, hey, here's another one. What do you guys think of that? Let's put all of our heads together. Whether it's our investment team, our asset management team, our strategy and executive team, and then maybe if there's a property manager on that particular area, we bring them in and kind of have that conversation, toss it around, and see if it's something that we all collectively want to do. So, team may not be a specific number, like, oh, there's 5 of us on a team, but it's more role and responsibility based.
Got it. Okay. Do you, Keshav, do you have other questions you want to ask?
Not that I can think of right now, no.
Do you have something that you typically convey to passive investors that you think the audience would want to hear? Some nugget of wisdom that typically you don't hear or maybe it's from some other individual that you don't normally hear from a GP, right? GPs don't normally bring it up, but maybe a passive investor might want to hear.
I threw out one of them earlier, like having the mission base, the 3 C's, right? So that's one: community, collaboration, cash flow, right? The other thing is making sure that your GP team, understands that they don't know everything and they need to, what I call, fill your blind spots. So that's what teaming is to me. What teaming is really about. It's not about, oh, I got 6, 7 people on my team, because all of them could be all cut from the same cloth and they're just as blind as you are, right? But really, you need a team that allows you to fill your blind spots, right? So that's number 2. Number 3, I think, is really know your lane, know your game. If someone that's a GP came to me and said, hey, we're doing this great student housing project, and we want you to invest in it. And just last week, they were trying to sell me on some industrial, cold storage project. I'd be like, come on, guys, like, know your lane, know your game. Like, who are you? Are you self-storage? Are you a student housing? Like, are you new? Like, what are you? So understand that, from a GP, what I'd say is out there is, hey, make sure they know their lane and know their game, right? If you got the fly-by-night person that's constantly coming to you and popping up 11 o'clock in the afternoon, like, hey, I got this new deal, and it's in Tulsa, and I got this new deal, it's in Tennessee, I got this new deal, it's in San Diego. You're like, you're all over the map. So but those are just some of the things that is it mission driven, filling blind spots in terms of team, knowing your lane, knowing your game, sort of anecdotal to me, that gives me some sense of, A, purpose for me, but B, also holding others accountable in terms of what are those for them. And if they can answer that, then I know that there's sort of a business strategic alignment, and we can talk further.
Perfect.
Yeah.
I think that's it. If you wanted to have anyone in the audience contact you, how can they best contact you? How can they best reach you and your team?
The best way to reach me is through the website. It's Relequity, REL equity.com. We have means of connecting there, whether it's, there's an email there, there's a contact us, and there's some other means of reaching out to us directly. So that's the best way. That's RELEQUITY, Real Equity, no A in it.com.
Great.
Yeah.
Well,
so this has been awesome.
Yeah, thank you very much for the presentation again, Justin. So just to recap, learned quite a few things today. Started with your background, your passion for building things, and I love the slogan: "If you think it, design it, you can build it." And then you went into the main pillars of what to look for in evaluating opportunities. You obviously evaluate the team, but you have to have make sure that your team has that you're investing in has a mission alignment, and that they really understand their buy box and buying criteria. You also talked about the 3 C's: community, collaboration, and cash flow, which is great. Happy people equals happy occupancy or high occupancy. I like that equation. You went through the red flags, which is great. Talked about interest rates. I love the book, Nothing Down, and thinking alternatively about circumstances. That's always great, especially in this interest rate environment. You really don't know what to expect. But then you also mentioned that, do I have the right deal? And having the investors, best efforts in mind, and making sure that you look out for the investor. I love that approach as well. And then really just the different type of investors in the appreciation market, cash flow market. That's really useful. And then the nuggets, making sure your GP doesn't know everything, that you have the team to kind of fill your blind spots, and that the know your name, know your lame, know your game. I love that as well. Everyone should have that buy box, know what they're specialized and focused on. I love it. But thanks. Again, thank you very much for the time you spent today. And of course, you know how to contact Justin at relequity.com. And this podcast will be recorded, or is being recorded. Again, thank you very much, Justin, for taking the time out in your busy schedule to speak to us and our audience. Don't forget to like and subscribe to our podcast on whichever platform you're listening to make sure that we can continue bringing you the best educational content. And again, thank you, everyone. Until next time, keep learning to invest for generational wealth. Thanks.